Our commodity index funds a good way to invest in commodities. Imagine investing in commodities without having to buy barrels of oil or tons of wheat yourself. Instead, you can use something called commodity index funds. These funds track a group of commodities by using futures contracts, which are agreements to buy or sell a commodity at a set price in the future. This lets investors get exposure to the commodity markets without owning the physical goods. Commodity index funds are popular because they help spread risk across different commodities. Since commodities often don't move in sync with stocks or bonds, these funds can add diversity to an investment portfolio. They can also act as a hedge against inflation, because prices for commodities tend to rise when inflation is high. Most of these funds don't buy physical commodities like gold bars or oil barrels. Instead, they invest in futures contracts, which are standardized agreements to buy or sell a commodity at a future date. The fund manager rolls over these contracts as they expire, which can sometimes lead to a situation called Contango, where futures prices are higher than current spot prices. When this happens, rolling over contracts can cost more, which might reduce returns. Another factor to consider is backwardation, where futures prices are lower than spot prices. This situation can benefit investors because rolling over contracts might cost less. However, futures markets can be volatile, and prices can change quickly due to global events, economic shifts, or government regulations. This volatility can cause the value of commodity index funds to fluctuate sharply over short periods. Tracking error is another point to keep in mind. It measures how closely the fund's returns match its benchmark index. Fees and trading costs can cause the fund's performance to lag behind the actual commodity prices. So, it's important to look at the fund's expense ratio and how well it tracks its index before investing. In summary, commodity index funds can be a good way to gain exposure to commodities without the hassle of owning physical goods. They offer diversification and potential protection against inflation. But they also carry risks like market volatility, tracking errors, and costs associated with futures contracts. Carefully reviewing the fund's strategy, fees, and market conditions can help determine if these funds fit your investment goals.